Welcome to this explainer. Today we're diving into a massive mystery surrounding Uber's Q2 2026 earnings. We're going to unpack how on earth a company can post literally record cash flows while simultaneously suffering a major stock drop. It's a fascinating quarter, really, and it perfectly captures this insane tension at the absolute heart of the company's future. On one side of the ledger, you've got incredible expectation-busting numbers, but on the other side, existential questions about what exactly Uber is worth in a rapidly approaching autonomous future.
Right, let's just get into this massive contradiction. How does a business generate a historic $10 billion in free cash flow over a trailing 12-month period, yet watch its stock plummet 30% from its peak? I mean, that $10 billion mark, that is a first in Uber's history. It demonstrates real, undeniable financial strength. But, Wall Street, they aren't just looking at the cash in the bank today, they're terrified of what tomorrow looks like. So to really solve this paradox, we've got to peel back the layers of this earnings report.
Section 1. Inside the Q2 numbers. This is truly a tale of scale and cash.
Let's kick things off with the sheer volume of money moving through the platform. Gross bookings soared 24% year over year to a massive $58 billion, actually beating Wall Street's $57.2 billion estimate. And here's a super cool detail for you. This surge was heavily driven by an influx of more than 8 million tourists using the app in host cities during the FIFA World Cup. It just goes to show how huge global events act like a massive tailwind for Uber's core business model.
But beyond just the dollars, the scale of this platform is simply staggering. Right now, Uber is boasting 208 million monthly active users. Think about that. And those users, they took a grand total of 3.9 billion trips this quarter alone. That's an 18% growth in trips. Even more impressive for a company this mature, they just added the most first-time users over the past year than in any comparable period in the last 5 years. They aren't just keeping the users they have. Their funnel is wider than ever. Now, revenue did grow 12% to $14.19 billion. Okay, yeah, that just barely missed estimates of $14.24 billion, but that was strictly due to a specific accounting change in Britain that reduced reported sales growth. It didn't affect their underlying economics at all. In fact, their adjusted earnings per share absolutely crushed it. They beat the consensus, coming in at 81 cents, which is a massive 35% jump from last year.
And honestly, the profitability is just taking off. Adjusted EBITDA jumped 33% to $2.82 billion, pacing well ahead of expectations. So bottom line here, Uber is definitively printing cash and proving that their core ride-hailing and delivery model works brilliantly at scale.
So here's the absolute crucial point. With numbers this strong, historic cash flow, massive user growth, profitability spiking, why did the stock fall 3% immediately after this report? What exactly is threatening Uber's core economic moat? If the present is so incredibly bright, why is the market so worried about the future?
Well, that brings us to Section 2, the Robotaxi threat, soft guidance, and Waymo's shadow.
Right out of the gate, investors were a little spooked by a soft forecast. First, their Q3 earnings projection came in at 84 to 88 cents, which missed analyst estimates by just a penny or two. On top of that, foreign exchange headwinds are expected to trim about 1 percentage point off their bookings growth. And finally, operating expenses rose 10% in Q2 as Uber ramped up spending across marketing, research, and admin. But let's be real, these are minor bumps in the road compared to the giant elephant in the room. The much bigger story is Waymo. Back in June, Uber wound down their Robotaxi partnership with Waymo in Phoenix. Then, literally just weeks later in late July, news broke that Waymo was exploring options to exit their exclusive partnership entirely. This rapid sequence of events sent Uber's stock tumbling 4% in a single day. The underlying fear here is palpable. I mean, if Waymo can build a standalone ride-hail app and doesn't need Uber's platform anymore, Uber loses its indispensability. In fact, Morningstar actually lowered its fair value estimate for Uber from $85 to $76 based entirely on this growing competition in urban areas where Uber currently commands really strong pricing power. But hold on, to put this robotaxi threat into a proper David versus Goliath perspective, let's look at the actual physical footprint. Waymo currently operates just over 3,000 vehicles in 10 cities. That is a microscopic fraction of Uber's massive network of 208 million active monthly users spanning the globe. So while the technological threat is very real, the current disparity in pure, unadulterated scale is massive.
Which leads us to Section 3, the $10 billion bet and Uber's massive pivot.
Pushing back against all this Wall Street panic, CEO Dara Khosrowshahi specifically noted that trends in San Francisco, where Waymo has operated for years, remain, quote, very, very healthy for Uber. He made a point to emphasize that Uber is playing offense here. As he puts it, they're investing from a position of financial strength to build the world's absolute largest platform for autonomous vehicles.
So in practice, what does that look like? Well, Uber is placing a staggering $10 billion bet on autonomous vehicles over the coming years. This capital is being rapidly deployed across equity investments, infrastructure, and a massive, tangible commitment of 120,000 autonomous vehicles to their network. They are making absolutely sure that when the AV revolution happens, those vehicles are routed straight through the Uber app.
And get this, that strategic pivot comes right on top of another blockbuster move, a $14.8 billion acquisition of Delivery Hero. Uber is funding this with their existing liquidity and debt to aggressively expand their global delivery empire. They're essentially building a two-front war chest here. They're locking down global food delivery scale while simultaneously investing billions to guarantee they are the undisputed dispatch system for the Robotaxi future.
All right, let's move to our final section, Wall Street's verdict, the bulls versus the bears in the AV future. So, the short answer to whether Wall Street is buying this pivot, yes. Despite the Robotaxi panic driving all the headlines, Wall Street remains fiercely bullish on the long-term story. Out of the 58 covering analysts tracking the company, an overwhelming 86% are still recommending a buy. The analyst community basically believes that while the timeline for autonomous payoffs requires some serious patience, which, by the way, is exactly why estimates for Uber's 2026 profits actually dropped 17% from a year ago, the underlying business model remains incredibly sound. When we take a look at the actual price targets, the average sits at roughly $106.70. That implies a highly attractive 48% upside from current levels around $72. You've got firms like BMO Capital reiterating a buy with a $119 target, arguing that investors should just ignore the M&A noise and focus on healthy organic results. Guggenheim is the most optimistic of the bunch at $125, while Wedbush remains slightly more cautious at $91. But overall, the consensus is pointing sharply upward.
On the flip side, though, the bear case is crystal clear in the valuation. Uber's 18x forward earnings multiple actually sits below the broader S&P 500's 20x multiple. For a high-growth tech platform, that's pretty unusual. It clearly indicates the broader market is currently pricing in the risk that autonomy inherently threatens Uber's core economic model. If Tesla or Waymo scale up consumer-facing apps perfectly, the huge fear is that Uber's platform loses its indispensability altogether.
So if you're a long-term follower trying to make sense of this, the next 12 to 18 months will be absolutely critical. You should keep your eyes locked on three main things. First, actual AV deployment numbers. We're talking real cars on the road, not just flashy PR announcements. Second, watch closely to see if Waymo pushes direct-to-consumer moves in more markets. And third, track the integration progress of that massive Delivery Hero deal to see if it really pays off. Uber has the cash flow and flexibility that its competitors severely lack, but execution over the next year is literally everything.
Ultimately, as Uber uses its incredible user density and absolute mountain of cash to position itself as the best aggregator of fleets rather than just an exclusive partner to one, we really have to ask the defining question of this era. Is Uber destined to become the ultimate, irreplaceable platform for the autonomous vehicle future, or are they just a highly profitable middleman waiting to be bypassed by the tech giants? Keep watching those numbers because the answer is absolutely going to reshape the entire transportation industry. Thanks for joining me on this explainer, and I'll catch you next time.